Is Twitter stock a buy? That's what we're going to be looking at in today's video. We're going to be looking at whether Twitter stock is a good stock to invest in right now, or is it just a bad stock that's not going to go anywhere in the long term. We're going to be looking at whether Twitter stock has potential as an investment. This is a series on the channel called Buy or Beware, where we take a look at stocks that are requested by you guys, the viewers. So thank you to Pierre Films for recommending Twitter stock to be reviewed on the channel. If you want to see any other stock reviewed on the channel, if you want me to take a look at any other stock, let me know down in the comments below and I'll do my best to review that stock on the channel. But for now, let's get right into the video of looking at Twitter stock. Is it a buy or not? Right now on screen, I have a screenshot of Twitter's 1-year stock chart, and we can see that they have had a major volatile ride. Over the past 1 year, they had 2 major hits. They used to be up at $45 per share, but now they're only trading at about $30 per share, and they hit a low at about $20 per share. So they've had one of the most volatile rides in the market. They went down almost 50% from their highs and lows, which is absolutely insane. Like, this stock represents what volatility means. And more recently, they had a drop from $39 a share all the way down to $20 per share due to the state of the market right now. However, they have recovered slightly, and now they're all the way back up at $30 per share. So why have they recovered? So what has caused this sudden stock price recovery, and is it indicative of long-term potential growth? So one of the big reasons Twitter has been able to recover some of their losses is due to this piece of news that I saw on the CNBC. Twitter announced that they told their employees that they can work from home forever, not just for one day or until the pandemic is over. They said forever. Even once the economy and the markets are normal, they can still work from home if they choose to. So you might be wondering, why would they do this? Why would Twitter just let their employees work from home? You might be wondering, why would Twitter do this? Why would they let their employees never come back to the office if they chose to? Well, one of the big reasons is that employees are now realizing, hey, I can work from home during the pandemic, and I really like it. I'd rather stay home from work, not have to commute back to work in the office every day. I save money on gas, and it's just more comfortable for me. So Twitter is really looking out for its employees and making sure that they're having a happy life and that they're comfortable. So this is just really Twitter's looking out for its employees. That's one of the big reasons why Twitter is doing this. However, you might be wondering, okay, why would this affect their stock price? So what? Their employees are more happy. That's not going to make them more profitable? Actually, doing this is going to decrease a lot of their costs. I was recently watching something on CNBC, and it was Kevin O'Leary from Shark Tank. He's a really smart guy, a really intelligent investor, and he was essentially saying after the pandemic is over, there's going to be a lot of offices, a lot of office buildings, but no employees in them. And I was recently just saw an article on CNBC also, where Jim Cramer, also a really smart investor, and he had a really similar thesis. They were essentially saying that once the pandemic is over, businesses are going to realize that my employees can work from home. That means I don't need to pay for them to stay in the office all day. They can work from home, be just as productive, and I don't have to pay for the office. I can save huge amounts of money by not having an office space. Now I don't have to pay my utilities. I don't have to pay a lot of rent or lease. I don't have to pay any janitors to clean up the office building. I'm just saving so much money by having employees work from home. So by Twitter making a move saying that, you know what, our employees can work from home if they choose, they're essentially saying that we have the capacity and the ability to have many of our employees not work in offices anymore. Over the long term, this can save them a lot of money on major costs associated with running an office building. So this actually can help their long-term profitability, which is a really good sign. It's a really good pro to invest in Twitter stock because they can just become even more profitable, and it helps explain why their stock price has recently gone up a lot. Also, their stock price has partially recovered because they had really interesting quarter one results. Twitter reported in their quarter one report of 2020 that they had 24% year-over-year growth in monetizable daily active usage, MDAU, and total revenue of 808 million. They saw a 3% increase in their revenue year over year, and they saw a huge jump in their monetizable daily active usage. It went up by 24%, and that's absolutely huge. And if you don't know, monetizable daily active usage is just a measurement of how often and how much people and consumers are using the Twitter platform. A 24% increase in their MDAU means that they're seeing 24% increase in usage on their platform. It just generally shows that consumers like their platform. It's a really nice platform and they enjoy being on it. But it also helps their revenue, because if more people are using their platform, they can show more ads. If they can show more ads, they get more revenue. So it's a really good sign for Twitter that they saw such a large increase in MDAUs. That alone helped increase their stock price by a couple bucks, which is pretty significant given that the stock price was just at $20 just a few weeks ago, and now it's all the way up at $30. So their quarter one results, and along with their ability to allow employees to work at home, has really helped their stock price partially recover recently. So I mean, they have some really strong pros, and historically they have been doing pretty well. Right now I just put up a screenshot of Twitter's annual revenue and profit, revenue in the green bar and profit in the blue bar, and we can see that revenue has been steadily increasing for the most part. It took a dip during 2017, but after that it's been steadily increasing. And same thing with their earnings. It's been steadily increasing. 2016 it was a pretty big negative. 2017 it was a small loss. 2018 a pretty nice and large gain. Then 2019 same thing, a pretty large gain even with some growth. So there are some good pros with the stock overall. They had a pretty strong quarter one result so far, with a large increase in the amount of people using their platform, and they've been able to handle the situation well, and they even have potential to allow their employees to stay at home, which can help bring down some of the costs associated with their business. And they're on the right track with their historical revenues and profits. They've been steadily increasing, which is just on the right track. That's exactly what we want to see. But there are significant downsides and cons with this stock. First off, let's take a look at their valuation. Right now on screen, I have a screenshot of Twitter's historical PE ratios. And we can see that it's hovered between 15 and 20. And the red line really represents about what their average historical PE ratio is. And right now, we can say that their PE ratio is about average to what it's been historically. It's right at the red line, so it's like an average valuation for Twitter. It's not too high, it's not significantly over the red line right now, but it's not really below the red line significantly either. So it's trading at roughly what it normally does on a PE ratio basis. So it kind of shows us that the stock is not severely discounted at a good price, but it's not overly valued either. So I mean, is that a pro or con for Twitter? It's not overvalued, but it's not undervalued either. And I would say that's kind of a con for Twitter if you want to invest in it. Just because you usually want to buy a stock when you think it's undervalued, not when it's fairly valued. And right now, just given that it's trading at a PE ratio that's really similar to how it's been trading historically, it just shows us that it's not undervalued right now, which is a really big con if you want to invest in Twitter right now. And also, their quarter one results were pretty terrible when you take a deeper look at them. So before I said, you know what, they had pretty strong quarter one results. We saw a 24% increase in their usage, and they saw solid revenue growth. Well, when you take a look a little deeper and their net earnings per share, you can see that it was terrible. During quarter one of 2020, they had lost 1 cent in earnings per share, and that's terrible. That's absolutely disastrous. Last year during quarter one, they had 25 cents in earnings per share. They went from making 25 cents in earnings per share to losing a cent in earnings per share. They went from positive to negative, which is absolutely disastrous. Like, it just took such a big decline in one quarter. And you might be saying, you know what? This is only temporary because it has to do with the pandemic and the state of the economy right now. And I don't think that's really the case with Twitter specifically. You have to keep in mind that quarter one for Twitter is during January, February, and March. January and February were normal months. There was no pandemic that was severely affecting their business. And the pandemic only started in the middle of March, where it really started to get serious for Twitter. So if the business was really doing well during the first 2.5 months of quarter one, their revenue and net income should still be up. Their revenue was up, but not their net income. It completely collapsed. Even though most of quarter one was a normal year. So even if the pandemic didn't happen, they might have just broken even or made a cent in earnings per share, which is still a huge decline. Is a trend that began in 2016 of them consistently growing their net income. Is that just going to stop right now? Is it just going to go down and they're not going to become profitable anymore? Or are they going to become slightly profitable? And I'll be honest, I don't know personally what's going to happen, but it's not going to be good. They're not going to continue that trend of growing their net income, which is a really bad sign for an investment. And they have been taking huge hits due to the pandemic. According to this article from MarketWatch, Twitter disclosed that ad revenue dropped 27% from March 11th to March 31st. Their revenue dropped 27%. That's huge. It's not a small decrease in revenue. That's absolutely huge. And that even occurred in spite of them having more usage on their platform. They saw a huge usage, 24% increase in usage on their platform. But nonetheless, they saw a huge decline in their revenue. 27% is a huge number. So they're taking huge hits due to the pandemic. And you have to keep in mind that they did not even make a profit during quarter one, even though that was mostly a normal year. What's going to happen when the pandemic really starts affecting their business for a whole quarter? Is quarter two going to be a huge loss for Twitter? That's what it looks like right now. They did not make a profit during what was pretty much a normal quarter. During quarter one, they did not make a profit. And that was pretty much a normal quarter. What about quarter two, when the pandemic is really going to hurt their business, where they're going to have a 27% drop in revenue? How bad is the situation going to be? And I'll be honest, it looks very bad right now. And I don't know why their stock price is going up so much in spite of all this news. When you take a deeper look at Twitter, it looks very scary, at least in the short term. And here's just a screenshot of what analysts are expecting Twitter to make in earnings per share during this year. The column that says current year 2020 shows what they're expected to make in earnings per share this year. And the column that's to the left of it that says current estimate 7 days ago, that's when the estimate was produced by analysts. So 90 days ago, analysts were expecting Twitter to make 92 cents in earnings per share this year. But then they revised their estimate, and 60 days ago, they were only expecting 89 cents per share. So that went down a bit. But then now a more recent estimate that was done 30 days ago shows that they're going to make 72 cents in earnings per share. So that went way down from 89 to 72 cents. That's just a huge drop. But then it gets even worse. According to an estimate done 7 days ago, they're only expected to make 48 cents in earnings per share. So you can just see the trend. The further we get into this pandemic, the worse their earnings per share is expected to be. Their estimate keeps going down. How low can this go? And it's really likely that they might not even make a profit this year just because the estimate keeps getting revised down. So Twitter's in a really bad situation right now. Their earnings estimate keeps getting revised down, and I don't know how low it's going to go. It just looks really bad for the company right now. And if you calculate a forward PE ratio, which is just their current stock price divided by their expected earnings per share this year, you get a forward PE ratio of 68. 68 is huge. It's such a high PE ratio. And keep in mind that when we're looking at Twitter over that time frame, they've never had a PE ratio over 20. But now this year, it's really likely that they're going to have a PE ratio of about 68, which is just huge based off of their earnings per share that they're going to make this year. Their PE ratio is so high. It makes this stock really unattractive to invest in right now. And when you compare to something like a Facebook, right? Facebook has a forward PE ratio of about 28 to 30. That's less than half of what Twitter's forward PE ratio is. and Facebook is really handling the situation well, and they're still expected to grow. I just did a whole video on Facebook, so I'm not going to talk too much about it right now, but I'll leave a link to my video about Facebook in the description. I highly recommend that you check it out. It goes in a lot of detail about Facebook stock and what are my thoughts on it and whether I think it's a good investment. Facebook is still expected to grow. They're handling the situation really well, and their forward PE less than half. So I mean, it just doesn't make sense to invest in Twitter right now when one, Facebook looks like a better investment just in general, and two, Twitter is just way too overvalued. Their earnings per share is literally collapsing in front of our eyes. Their forward PE ratio is just way too high. It's trading like an Amazon right now. Twitter is trading like an Amazon, which is really absurd right now. And their revenues and earnings per share is collapsing, and I'm not sure if there's going to be too much hope with this stock in the long term, even given that they didn't even make a profit during Q1, which was pretty much a normal quarter for Twitter. So overall, I would not invest in this stock. But thanks for watching the video. Make sure to drop a like and subscribe down below, and let me know what are your thoughts on Twitter. And if you want me to review another stock, let me know down in the comments. I would be happy to review it, and I'll do my best to get to it. But thank you for watching this video.